Charles, great to have you back. Welcome back.
Good morning. Good to be with you this morning.
Before we talk about, I guess, the Fed and sort of monetary policy impact from China, Yellen this morning at a conference did suggest, as others have, that it might renew some of the supply chain worries we had earlier in the year.
Well, certainly that is a risk here. I think we just have to monitor closely the evolution of the lockdown policies in China to see if there is no significant easing in the lockdown. I think that we could see renewed further supply chain difficulties, which could put further pressures on price levels. On the other hand, the Chinese economy is clearly in a relatively weak state, especially compared to its historical performance. And this could ease some of the pressures on global commodity prices. So I think we have to monitor the situation closely to see which way this cuts in the weeks ahead. Certainly, we've not yet seen any dramatic move toward reopening the economy, nor have we seen a major shift away from zero COVID.
Right. So with that, and obviously on watch for Powell this afternoon, your overall view is that the Fed is going to remain vigilant in fighting inflation, even with Chicago PMIs in the 30s and pending homes down 40%, and cotton and chicken and commodities down, and this curve inversion. You think that they're still going to remain resolute?
Well, I think that is the highest probability, really. I mean, I think that they know the recent American history. They know that in 1980, after an initial period of serious tightening, that Paul Volcker actually eased up a bit prematurely. And the consequence of that was that when he had to come back in late 1980, early 81, he really had to hammer the economy. And I think that Powell and his team want to avoid that this time. I think also they're in the process of rebuilding their credibility in markets to ensure that inflationary expectations do not get out of control. So those various factors, in my view, argue for continued vigilance, continued tightening, obviously likely at a more moderated pace than we've seen, because over the last 5 months, we've seen the most historically rapid rise in Fed rates that we've ever seen in modern history.
So in light of that, Charles, is stagflation here a real risk? And if that is a risk on the table that the Fed is watching very closely, does that mean it is more than willing to, and perhaps it is even inevitable, that we're going to get some sort of recession to avoid that?
Well, our base case still has the U.S. barely avoiding a recession, but to be quite honest, it's touch and go. I do believe that the risk of a recession in the U.S. are quite significant. The risk of a recession in Europe, obviously, are much higher. Consider the evolution of the Chinese economy plays out. But if I focus on the U.S., I think we have at Partners Group quite a considerable concern about a stagflationary scenario evolving over the next few years, where the Fed gets inflation down to, let us say, something in the range of 3 to 4%. But nevertheless, it's higher than they would wish. It's very difficult to envisage a rebound in that environment, in my view. We are, after all, in a period of deglobalization. I think we have to recognize that the forces of deglobalization, for security reasons, for trade protectionist reasons, are all around us. And I think the combination of these factors raises a serious risk of a stagflationary environment as we saw in the late 1970s.